All right, great everyone. Thanks for joining me again. We're going to look at today's free theta trade. And before we get started, do take a look at the risk disclosure here. Got it on the screen. Be aware that only risk capital should be used when trading, and past performance is never a guarantee of future results. So here we go. This is ThetaTrader. You can see all the different theta trades available every day, whether you're bullish or bearish or have a non-directional bias or outlook about what's going to happen. We're looking at the E-mini S&P 500, NASDAQ 100, and Russell 2000. I thought we'd look at some dragonflies here on the S&P 500. I'm going to focus on this one. This is the August week 3 expiration. It has 75 days till expiration. And we've drilled down on that, and here's what it looks like. You're selling these 4 out of the money calls and buying 3 further out of the money calls and 1 closer to the money call. And then you sell 4 out of the money puts and you buy 3 further out of the money puts and buy 1 closer to the money put. And of course, here's the current market price here. And the idea is you have this large margin of error between the calls you sell and the puts you sell. And you're looking for the market to sort of just chop around and go sideways. And here's the expiration date of those options. And the idea is to close out that position for less money than what you received for it, because you received net premium on this put spread and call spread that you're selling. And all the strike prices here are chosen by the algorithm, so they're not always going to be 50 points different from one to the other. You'll notice here the 56.75 call is 50 points closer to the money compared to the 4 that you sell, and it's the same with the put structure here. The 4900 put, it's 50 points closer to the money compared to the 4 that you sell. So that acts as a more, let's say, risk averse structure compared to an iron condor, because you have this additional call that you own and put that you own, and that will gain in value much more quickly than the ones that you've sold, because the delta is higher and theta decay won't work against it as rapidly. And here's what it looks like on the graph. The table, as we say, you have 75 days till expiration, settlement value, your premium collected, put risk, call risk, commission, cash required, profit potential at expiration. And this is something called the targeted return on cash, and it's really here along with the targeted annualized return to compare one theta trade to another. So depending on the days till expiration, of course, that makes a big difference. And you'll notice the 4 puts that are being sold, the strike price here, 48.50, have a delta of 9.56. That means there's over a 90% probability that those options will expire out of the money. And that's how options traders look at deltas very often. And that's just according to the math and the probabilities. And the same thing with this call. The algorithm selected this call here with a 6.61 delta. So about a 93.4% probability that these calls that are being sold will expire out of the money as well. So we'll just go ahead and accept all the strikes here that the algorithm has chosen for us. It always defaults to sell because you're selling the spread and collecting premium. Quantity defaults to 1. Of course, if you change it, you can see the cash requirements move and the profit potentials and so forth move up and down. We'll do 3 of these. We'll leave it at 8 points, and then we'll just press place and just a demo account here, and that's it. So that's all there is today, folks. Thank you for joining us, and feel free to subscribe to the free demos and the trade alerts, and also subscribe to our channel. Thank you. Bye-bye.